Hey, man, I want to start with your word of the day. It's blindside. Do you think investors have been blindsided? What's going on?
Yeah, kind of a good way to say it. I mean, we're deep into football season, and it kind of sounds like a reference to that, but it's not. I mean, we chose the word. I chose the word because I think investors get or could get blindsided here if the concentrated side of the market starts to unwind. When you got too much money piled into too few names, even a small shift here in sentiment can turn the S&P pretty quickly.
All right. So you're looking at sentiment. Can I talk to you about technicals really quick? And I know you're not really a technical stock analyst or anything, but
Sure.
Fundstrat out with a note looking at the XLK, big tech ETF, and just basically showing if you look at the 50-day moving average, it has a lot of support. It's well above that bounce off the 50-day moving average line. So in their mind, they see a lot of technical support for the sector, despite some of the headwinds we're talking about, valuation, everything else, and they actually see it moving higher. Is that something that you pay attention to when you're looking at this sector, the fact that it may have just kind of hit a low and it can bounce from here?
Yeah. I mean, you're correct. We're not too far into technicals, but I will say this. So here's something to think about. Right now, you've got the top 10 stocks, mostly mega cap AI names. I mean, they make up 41% of the S&P 500's market share. They've driven more than 70% of this year's return. So we look at the concentration risk as the biggest risk right now in the market. If you look at the equal weight S&P, I mean, every stock counts the same, and it's only up about 6% year to date, where you've got the cap weight up close to 16%. Huge gap, no question. It tells you the average stock's just not keeping up. I mean, even passive investors, I think they're making a pretty constant, a big bet with the concentrated market just by owning the S&P.
It's so funny you say that, and a lot of worries about valuation and everything else this week, but then you keep seeing these notes. Like Morgan Stanley came out with a note yesterday and looking at what they call early AI adopters. Now, this is their data. They say 24% of early AI adopters are seeing the benefit from AI, up from just 15% a quarter ago. In the note, they go on and say that some of this adoption and efficiency gains, they actually support some of the elevated valuations. If we continue to see companies actually gaining from AI and seeing margin benefit, and even though we don't like to see people lose their job, but see an ability to reduce headcount, doesn't that justify these valuations? Doesn't it justify the gains in these stocks?
I mean, you could say that, but you got plenty of AI-linked stocks that are trading at forward PEs close to 100 times. I mean, even 200 times. I mean, the broader S&P sits at 23. So, I mean, here you go. Case in point. Look at Palantir this week. I mean, great quarter. They beat, but the stock's already up 170% year to date. So we just saw it. Even a beat wasn't enough there. So I just think when good news isn't good enough, just in general, it's usually just a sign of some sentiment fatigue. And we saw it last quarter with NVIDIA's earnings.
All right, sentiment fatigue. I want to talk to you about something else. Just the momentum in the market. A couple just touch points. So look at the U.S. dollar. Back on September the 17th, it bottomed at least this year. It's up more than 3% since then. I'm looking at Bitcoin. It peaked back on October the 6th. Gold even. It peaked back on October the 20th. It's moved to the downside since then. So what does that say about the sentiment in the market and where investors are looking to go? And by the way, in this quarter, Q3, healthcare is the leading sector.
Yeah. Yeah, defense doesn't necessarily, when we're looking at this and just portfolio positioning in general, it doesn't necessarily mean that you have to shift completely to cash, to fixed income, to things like that. I think we're just leaning more into quality. And you mentioned it with healthcare. I mean, there's a whole group of quality companies. I mean, I think that we like dividend growers,
Right.
strong balance sheets, consistent earnings that have been totally overshadowed
And
by
your pick's
AI.
Merck. So that kind of fits that,
Yeah.
that category that you're talking about.
Correct. They fit perfectly. I mean, they've been tossed aside by the market. The stock's down close to almost a third since last July, and it's mostly because of some of the concerns around Keytruda just losing exclusivity in 2028. We think it's fair. Keytruda, they make about half Merck's revenue, but the things we like, just getting into the stock in general, we like healthcare, but just getting into this company specifically, you're getting almost a 4% dividend yield, 3.8% yield, and it's consistently grown for over a decade. And when you add in
Got it.
buybacks here, it's close to an 8% shareholder yield.